Stop scrolling. I want you to think about a specific morning, March 18th, 2013, in Cyprus. People woke up, went to check their bank account, and found they couldn't access their money. When the banks reopened 3 days later, the rules had changed. Up to 47.5% of certain deposits had simply been seized, used to bail out the banks. And here's the part that should stop you cold. The legal framework for doing the exact same thing in the United States already exists. It was quietly written into law as part of the Dodd-Frank Act. And with $36 trillion in national debt, a banking system sitting on hundreds of billions in unrealized losses, and the political will for another public bailout basically gone. The next financial crisis might be funded the same way Cyprus was funded, with your savings. This isn't a conspiracy theory. This is reading the law, following the money, and understanding who the system turns to when it runs out of other options. By the end of this video, you'll understand exactly how this works, who is at risk, and the specific moves to make to get your money out of the line of fire. To understand why your savings are the new target, you have to understand why the old bailout playbook is dead. After 2008, the world's central banks ran the biggest monetary experiment in history. The plan was simple. When the system breaks, flood it with printed money. The Fed launched quantitative easing, round after round of bond buying that injected trillions into the banking system. The government launched TARP, $700 billion to buy up junk assets from failing banks. It worked. The financial system stabilized. The stock market recovered. And remarkably, inflation stayed low. Why did inflation stay low? Because most of that new money stayed inside the financial system. Banks, still wounded, just sat on it. The printed money inflated asset prices, stocks, real estate, bonds, but didn't spill out into groceries and gas. Then came 2020, and this time they did something fundamentally different. They didn't just inject money into the banks, they sent it directly to people. Checks went out, enhanced unemployment went out, PPP loans went out. The money hit an economy with broken supply chains and ran straight through into prices. That unleashed the inflation dragon that had been sleeping for 40 years. And it changed the political game completely. The public's appetite for another 2008-style no-strings-attached bailout has vanished. Every voter now knows what printing money feels like at the grocery store. But here's the problem. The underlying financial system is more fragile now than it was in 2008. Government debt is at $36 trillion. Corporate debt is staggering. Banks are sitting on hundreds of billions in unrealized losses on the bonds they bought when rates were zero. The system needs a bailout bigger than ever. It just can't be a public one. So it will be a quiet one, a hidden one. And that's where you come in. Here's what most people missed. The next bailout isn't coming. It's already happening. Silently. Through programs most Americans have never heard of. Remember Silicon Valley Bank in March 2023? It collapsed because it was holding billions in government bonds that had crashed in value when the Fed raised rates. To stop contagion, the Fed created the Bank Term Funding Program, the BTFP. Here's what the BTFP did. It let banks bring their devalued bonds to the Fed and take out a loan, not at the crashed market price, but at full face value, the original price. Imagine your house dropped from $500,000 to $300,000 in value, and a bank gave you a $500,000 loan against it anyway. That's what the Fed did for the banking system. It was a bailout dressed in technical language. The BTFP program ended in 2024, but the principle, the Fed as a hidden backstop for bad bank assets, is permanently wired into the system through the standing repo facility and other mechanisms. It's a permanent, quiet bailout channel running in the background. Now, where do your savings fit into this? Your deposits are a bank's cheapest source of funding. You deposit $10,000, the bank pays you next to nothing for it. They turn around and lend it out or invest it at a much higher rate. Your money is the raw material for their entire business model. In this new world, where the Fed is quietly backstopping bank losses, there's enormous pressure to keep interest rates artificially low, even when inflation is still running. Because higher rates expose the unrealized losses on bank balance sheets. Higher rates make the government's $36 trillion debt more expensive to service. The system needs cheap money to survive. When the Fed keeps rates lower than inflation, when your high yield savings account pays you 3% when inflation is running 3.3%, you are losing purchasing power quietly every month. That's a hidden tax being levied on your savings to subsidize the financial system. But that slow burn is only part of the story. Part 2 is more direct and more dangerous. The term you need to understand is the bail-in. Not a bailout, where taxpayer money saves the banks. A bail-in, where depositor money saves the banks. Cyprus was the live preview. Over a quiet weekend in March 2013, the government shut the banks. When they reopened, depositors with over 100,000 euros discovered that up to 47.5% of their money above that threshold had been converted into shares of the failing bank. Shares that were essentially worthless. The authorities called it a bail-in. The depositors called it theft. Legally, technically, it was neither, because uninsured depositors are creditors of the bank, and creditors take losses. A lot of Americans saw that and thought, that's terrible, but it can't happen here. We have the FDIC. I need to challenge that assumption. Not to create fear, but because the complacency is dangerous. After 2008, Congress passed the Dodd-Frank Act. Buried deep inside is Title II, the Orderly Liquidation Authority, or OLA. It creates a legal process for the FDIC to manage a failing, systemically important bank. The explicit goal? Have the bank's private creditors absorb the losses, not taxpayers. Who are these creditors? Bondholders, yes. But the Dodd-Frank framework also explicitly includes uninsured depositors, any money above the $250,000 FDIC insurance limit. Under the law, that money is legally an unsecured loan to the bank. And under the Orderly Liquidation Authority, it can be used to absorb losses in a crisis. The Cyprus model isn't a foreign oddity. The legal machinery for it is sitting on the books in the United States. Now, to be absolutely clear, this has never been used on retail depositors in the US. Historically, regulators have found other ways to manage bank failures. The FDIC has protected even uninsured deposits in past crises by finding buyers for failed banks. But in a severe enough crisis, one bigger than 2008, one where no buyer exists, one where political pressure against taxpayer bailouts is overwhelming, that tool is there. And the people who wrote that law know it's there. The question is not whether the government wants to use it. The question is whether circumstances might force them to. If you're first hearing about the Orderly Liquidation Authority, and you're sitting there thinking, why didn't anyone tell me this? You're not alone. Hit subscribe if you want to keep getting this kind of information. Understanding how the system actually works is the first step to protecting yourself from it. Here's what to actually do. The fundamental shift in thinking you need to make is this. You can no longer be passive about where your money sits. The savings account, as the default, set it and forget it cornerstone of personal finance, has changed. You have to be the CEO of your own financial arc. Step 1. Know exactly where your money is and what's insured. The FDIC covers $250,000 per depositor per bank per account category. If you have more than that at a single bank, you are an unsecured creditor for the amount above that line. Either spread it across multiple FDIC-insured institutions or understand you're accepting the creditor risk. This is basic, but most people have never actually run the number. Also, look at your brokerage accounts. The stocks and bonds you own are yours and are held separately from the firm's assets. But any cash sitting in a sweep account is just another bank deposit, and it has the same exposure. Step 2. Understand the difference between currency and money. The dollars in your bank account are currency. They are a liability of the banking system. They can be created out of thin air. Money, in the historical sense, is an asset that holds its value and exists outside the system. Gold and silver have played that role for thousands of years. This isn't a gold bug argument, it's a diversification argument. Owning some physical precious metals means owning an asset that has no counterparty. No bank can bail in your gold bar. No Fed policy can create more of it. Step 3. Own productive assets, not just currency balances. In an inflationary world designed to reduce the real value of money, holding cash is a losing strategy. You want to own assets that generate income, dividend-paying stocks, income real estate, a piece of a real business. These assets produce returns that can keep pace with or exceed inflation. Your savings account is eroding. Productive assets are compounding. Step 4. Reduce your personal debt load. The entire system is built on debt. The safest individual position in a debt crisis is to have as little debt as possible. Every dollar of high-interest debt you pay off is one less claim the system has on your future income. Fixed-rate long-term mortgage debt is fine. You're paying back in inflated dollars. Variable-rate consumer debt is a trap. Get rid of it. Step 5. Watch the bank stress signals. The metric to watch is the FDIC's problem bank list, the number of banks on the watch list for financial weakness. It's public data. When that number rises sharply, the risk of a bail-in scenario becomes more relevant. Keep an eye on it. I'll link to the FDIC data in the description. Here's the bottom line. The final bailout isn't a future threat. The hidden version of it is already running. Through the Fed's backstop programs, through interest rates kept lower than inflation, through the quiet transfer of purchasing power from your savings account to the financial system. The more dramatic version, the bail-in, the Cyprus model, has the legal infrastructure in place in this country. Whether it ever gets used depends on the severity of the next crisis and the political landscape when it hits. What you can control: getting your money out of the most vulnerable positions, knowing your FDIC exposure, diversifying into assets that exist outside the system, reducing your debt, building a financial ark that can float regardless of what the storm looks like. The time to build an ark is before it rains. In the next video, we're going deeper into your savings account specifically and what banks are quietly doing with your money right now that you haven't been told about. Subscribe and hit the bell so you don't miss it. I'll see you in the next one.